I'm Ryan Kazmierski, editor of American Hard Assets, and this is today's American Hard Assets Market Minute. We're joined by Jonathan Kosares of USA Gold. Let's talk some more about the debt ceiling, Jonathan. We're about a week away from the deadline. Where are we headed with this, and does it really matter that much?
Yeah, I'm relatively unimpressed, might be the way to put it. I know we've had the government shut down here for a little bit better than a week, and it's starting to cause more noise, I guess might be the way to put it. Yeah, I think the longer we go, the noisier it gets. But in terms of the debt ceiling and the deadline next week, I saw that they floated a plan today where they're going to try to forestall it about 4 to 6 weeks, give a temporary borrowing authority, which is really familiar. They've done this kind of a thing before. So I think it's all kind of a non-event. I think they're going to raise the debt ceiling in the end because the consequences are too great, as they say. I don't know that they are. I mean, I'm sure that they would be great, but you got to start to wonder at some point how many raises of the debt ceiling become, or to what point until we get it to be a ridiculous level. It's already ridiculous. How much do you have to raise it by to not just have the same argument in a real short period of time? And so that's kind of where this whole thing's going to go. And I think that at some point the levels that we reach are going to exceed the risks that we would perceive by taking us to the brink and seeing what happens.
There's another piece of news that came out this week. Yellen was named the new Fed chairman. How does that affect the market in a positive or negative way?
Well, yeah, she was nominated, so she hasn't been named yet. But nominated is, obviously she wouldn't be nominated if we didn't think that she was going to ultimately be the reserve chair. But she's a dove, even thought to be more dovish than Bernanke, if you can believe it. So her take on things, I think, is going to be to keep quantitative easing full throttle, maybe even accelerate it. She might bring in new targets for unemployment. She's known to be really interested in where the unemployment level is. But I was watching an interview with James Rickards today. I couldn't agree with him more that I'm not sure how much quantitative easing really helps the unemployment rate. So it's really interesting to see this interplay between the Federal Reserve mandate, which is to keep unemployment low, and to keep interest or to control interest rates, and how they're interacting and whether or not they're actually of any influence on each other. So more than anything, I think people love a dovish Fed chair. They love free money, and it causes an inflationary pressure in the markets, which is what we've seen, where this concept of anybody who's involved in the markets is getting richer, and they're hoping for a wealth effect that then impacts employment, but that direct relationship hasn't been connecting. And so because they're following unemployment, I believe that Yellen will have to remain really dovish, which is probably going to be positive for both the stock market and gold.
All right, Jonathan. Well, it sounds like we've got some things to look forward to the next couple of weeks. I appreciate it.
You're welcome. Have a great day.